Ever wake up, check your phone, and feel your stomach drop? Imagine seeing the price of gold and silver bleeding red, looking like a total market massacre. In a matter of hours, nearly $7 trillion in value simply vanishes into thin air. For a beginner, it looks like the world has decided that hard assets are suddenly obsolete. I'm here to tell you, it's an illusion. What Wall Street obscures is a fundamental truth. The price you see on your screen isn't determined by people buying and selling physical bars of metal. Instead, it's driven by a hyper-leveraged ecosystem of paper gold, a world of digital promises, futures, options, and swaps. Think about the scale. While the physical market is relatively small, the volume of paper trading can exceed the actual physical metal by a factor of 100 to 1, or even a staggering 651 to 1. This paper market is the tail that violently wags the physical dog. When you buy gold on an app, you aren't usually buying metal, you're buying a highly leveraged digital promise. And here's where it gets deeper. Most people assume that when prices fall sharply, something fundamental must have changed. Maybe demand disappeared, maybe supply exploded, maybe the asset suddenly became worthless. But in the modern financial system, price does not always reflect reality. Price reflects leverage, reflects derivatives, margin debt, algorithmic trading models reacting to each other at speeds no human can comprehend. So when you see a vertical red candle on your screen, you aren't often witnessing investors calmly deciding gold has no future. You're witnessing forced liquidations. You're watching leverage unwind. You're seeing a digital chain reaction, where one margin call triggers another, and another, and another. So how does $7 trillion just vaporize? It doesn't evaporate physically, it evaporates on paper. It disappears from balance sheet because the price attached to digital contracts collapses. The wealth was never sitting in a vault somewhere. It existed as a mark-to-market calculation on a screen. Early 2026, the system panicked when institutional investors stopped accepting cash settlements and started demanding actual bars. That presented an existential threat, bank run on the physical vaults. Because here's the uncomfortable truth. The system functions smoothly only as long as most participants never ask for delivery. If even a small percentage demand physical settlement at the same time, the leverage becomes visible. To prevent the vaults from being drained, the exchange weaponized its own rules. They hiked margin requirements 5 times in just 9 days. On paper, it's called risk management. In reality, it forces traders to deposit massive new capital immediately, or liquidate. And when liquidation happens all at once, prices don't gently decline, they collapse. It was the financial equivalent of yelling fire in a crowded theater and then bolting the exits shut. During this entire wipeout, the actual physical gold and silver sitting in high security vaults didn't change. The ounces didn't evaporate. The bars didn't dissolve. The metal did not lose its atomic structure. Only the paper illusions burned. And that distinction matters, because over the last few decades, the financial system has trained investors to equate price with truth. If the number goes down, the asset must be weak. If the number goes up, the asset must be strong. In a world dominated by derivatives, price can temporarily disconnect from reality. Central banks have been net buyers of gold for years. They don't trade on emotion, they think in decades. Global debt levels are at historic highs. Governments continue running structural deficits. Monetary policy has oscillated between stimulus and tightening, but the long-term trend is clear. More liquidity, more credit, more monetary expansion. Volatility driven by leverage is not the same as a collapse in intrinsic value. From the outside, it looks chaotic. From the inside, it's mechanical. When prices fall sharply, fear spreads faster than facts. Investors question their decisions. Doubt creeps in. The narrative shifts from long-term fundamentals to short-term survival. This is where irreversible mistakes happen. Markets have always transferred assets from the impatient to the patient. So the real question becomes deeply personal. Will you be holding a digital IOU from a system that can disappear with a keystroke, or a physical asset that has survived the collapse of every empire in history? The answer isn't about fear, it's about awareness. It's about understanding leverage, psychology, and cycles. What looks like a massacre on a screen may simply be a reset in a much larger story, and that story is still unfolding.